Have you gone to your local bank, your local credit union? You're trying to buy an investment property and you can't qualify because your bank or credit union wants to use 2 years of your tax returns and your W 2, your 9 to 5. They want to see everything under the sun. Guess what? If you're new to the game or you're looking to buy your first investment property, you need to be utilizing a DSCR loan, which stands for Debt Service Coverage Ratio Loan. And how you qualify? Two ways. The only personal item that you actually have to share with a lender is your credit score. You need to have a 620 credit score or higher. Of course, if you are going to be in this game, the higher your credit score is, the better your interest rate is going to be. That I can tell you. The second thing, your property needs to be cash flowing. If it's not currently occupied and you want to go buy a property, it's rent ready, and you're going to rent it at that time, the lender will require you to get a appraisal. And on that appraisal, they'll do a schedule of rents, which will be based upon your local market. Whatever that is, that's the number you'll go by. And from that point, as long as you are having a debt service coverage ratio of 1.0 or higher, you're good. And all that means is you got $1,000 coming in rent and your mortgage payment is $800. You're above the 1% or 1.0. There are some lenders that will go below 1, but that is risky because now you are in the hole on a monthly basis, which means you're coming out of pocket to make sure all your expenses are being covered. So don't go there. Make sure your property is always cash flowing. You don't have to worry about your W-2s. You don't have to worry about your 9 to 5. What you do need to worry about is this. 1, down payment ranges anywhere from 15 to 20% of the purchase price. If it is a $100,000 purchase price, at 20%, you're talking $20,000. They are not using conventional overlays. And what that means is this. They're not looking at all the different aspects that a conventional loan will look at it, your job, like an appraisal outside of just schedule of rents. It still has to be appraised for a dollar amount, and it has to meet that dollar amount that you're purchasing it for. But they don't have all those additional overlays. Third thing out of the conventional, they are not going to want to look at your debt to income ratio on this loan. It's specifically only based upon the asset. The only thing, like I said earlier, is your credit score. Make sure you've got a solid credit score. That'll get you in this game quick and allow you to grow. If you're really looking for an entry point for this game, DSCR loans will get you there just for the simple fact you just need the 20% to get in. Now, to close, there's going to be closing costs. So that'll be title fees, lender fees, any type of local county or state fees. If you're working with a lender, which you got to be to get this loan, they're going to charge you some type of fees. So expect to be able to pay between percentage-wise from about 24% up to 28%, just depending on closing costs. Each state and area is different. Types of properties you can use. Single family, duplexes, triplexes, quads. Some lenders will let you do mixed use. Some will let you do short-term rentals, Airbnb, VRBO. As long as the property is producing income, you're good. If someone tells you from a lender perspective that you should be doing a deal and the DSCR is below 1, you need to run. Just run and keep on going. You should be running from the deal if you haven't done those numbers and realized you'd be losing money, because you have to pay your mortgage, PITI, principal, interest, taxes, and insurance. You have to pay all of those, and that's wrapped up into your actual monthly mortgage payment. So if your mortgage payment is $800 a month, you're losing $200 right off the top. how are you putting any monies in reserves on a monthly basis? And two, I don't know about you, you're coming out of pocket at least $200 a month just to keep that place afloat. Now, could you raise the rent over time? Yeah, but you've got 12 to 24 months to be able to make that up. And then once you get into the next cycle, let's say you're able to raise it another $200. Now you're breaking even. You're still going to be losing money at that pace because you have costs that you have to pay. You have reserves that you have to worry about. So guys, if you're a new investor and you're looking to get into this game, love to be able to talk to you, have a conversation about DSCR loans. They're very simple. I've closed over 50 of these in the last 9 months, and I'm looking to close another 50 in the next 6 months. So I'm willing to help you. I'm an investor myself. I know what it takes to get these done. I have access to over 100 different DSCR lenders in our marketplace that you want to buy more properties, especially since the market is starting to teeter-totter and start going down. It is now becoming a buyer's market, and there's going to be plenty of opportunities out there for you to capitalize.